Good morning to the Quantic Projects team. I'm going to start as required by showing a photo of my government issued ID. I think that's fine, and thank you very much. My name is Abong Bebey Blaise. I'm joining you from Cameroon. I'm a student of the EMBA class of October 2021. My presentation is going to be on the Biocon India case study, and this analysis is broken into three parts. So, firstly, I look at the advantages and disadvantages of running a pharmaceutical firm in India, followed by a second part on the advantages and disadvantages of operating a clinical trial company. And finally, I look at how these advantages could factor into Biocon's decision on whether or not to aggressively invest in the operation of its clinical trial company, Clinigen. So basically, an analysis of the Indian pharmaceutical market helps us to identify a number of reasons why firms would actually have wanted to invest in that market at the time. We're talking about advantages that run from a business friendly ecosystem to low production cost. Firstly, there was there's a season of unprecedented growth that is reported for this market. The most domestic market was growing by close to 15% at the time, while exports were also growing by about 21%. So it's on a global scale, the Indian market was experiencing the kind of growth that we want to invite any reasonable investments in the pharmaceutical industry. Secondly, India's government had established a long-standing policy to support the growth of its pharmaceutical industry by making some of these important science-driven facilitations that helped to build a young industry and to empower it. We are also talking about tax incentives that were a good thing to go by. In the state of Tanaka, for example, the government had set up a biotech incubator park in which companies were granted tax incentives and actually facilitated investments through favorable lease arrangements. Finally, the Indian market had this unique advantage of having readily available and cheap but skilled labor. We are told that the industry space boasts readily available, low and well trained, educated scientists and medical professionals, almost 10 times cheaper than what we could find elsewhere. In fact, the comparison between the US market and the Indian market showed that the medical professionals like doctors were paid over 10 times higher in the US and than the $15,000 that they were making per annum in the Indian market. Now, but things were not all rosy on all grounds. We identified a number of disadvantages why this industry was actually had a scary look. And the first is about competition. The Indian pharmaceutical phase, to say the least, is a red ocean with over 20,000 firms operating at a certain point in time. This brutal competition made it very difficult for newcomers to come in as they were stifled in the market. And also, the 1970 Indian Patent Act, which was voted by the Indian government, actually prohibited the use of patenting those intellectual property rights on issues related to medical innovation. So anybody could come in and make use of any available technology and information on the market. This made it really difficult for new firms to be able to come in with top-notch innovation and separate themselves from the lot, making blue ocean strategies a little limited. And also, finally, this is another point on which we want to talk about. There was limited access to external funding. We actually learned that most firms in the industry depended only on organic growth with limited access to private equity ventures, and up to 40% of investments were debt funded on bank loans, definitely increasing interest rates and making investments a little more difficult. So let's look at the second site about clinical research company. The Indian space had a couple of advantages which are actually linked to the growth of the pharmaceutical industry. First of all, India had become a global destination for outsourcing in research and development on medical issues, meaning that owing to its lower cost of operations, as we have identified earlier, the emerging pharmaceutical industry was increasingly becoming a strong destination for research and development contracts. And at this time, we are talking about 25% of global research and development in medical drug discovery that were actually being outsourced, making it a very, a positive side of the economy to invest in when you look at the amount of contracts that were coming from abroad. And secondly, India's diversified racial population meant that India was a good destination for clinical trial research. We're talking about the fact that the cost of recruiting and retaining patients for trials was actually lower than you find in around other markets in the world. But now there were a couple of issues to deal with. First of all, and the most important disadvantage of this market is that there were still fears about the unproven reputation of the Indian market in clinical trial research. Uh, Most multinational companies were still skeptical about India's capabilities to deliver on the sensitive task of clinical trials, with its strict requirement for scientific expertise. We could understand that most multinational firms, the examples of Pfizer, were still very dependent on their own internal systems to be able to go through the scrutiny of scientific research when it came to clinical trials, meaning that most Indian firms had not come up to the space. So finally, when we look at these advantages and disadvantages that we have discussed, it becomes evident that Biocon had to take a tough decision. But on this, we also think that Biocon Group had made a number of outstanding investments that gave them an urge if it was time to invest in the clinical trial research company, Clinigen. First of all, Clinigen was coming as the final point in Biocon development cycle, and it meant that this new company could rely on the group's reputation, its seamless work people culture, which is a very strong point, and its commitment to excellence. Secondly, with the rapid growth of contract research organizations in the industry, in the Indian industry, it was expected that clinical trial research was going to grow by at least 30% by the year 2010. And thirdly, Biocon initially saw Clinigen. This is to address the issue related to the value of clinical trial companies as perceived by the external market. Biocon did not intend to place Clinigen as a superior value part of the market. They wanted to have an intermediate between a middle to intermediate level of clinical values in terms of trials in order to be able to actually move up and invest progressively. So when we look at all of these points and basically the growth of the market and the fact that a lot of clinical research was increasingly coming to India, it is our view that Biocon Group had to make this final investment, which was going to be a final point in their development process from drug discovery to actually production and distribution. So, though our recommendation is not to have an aggressive approach, we want Biocon to invest, but to invest progressively, to make investments that are proportionate to the growth perspectives of the industry, to be able to observe and also to understand that this company does not come in to suck up all of their energy and finances at this early stage. So basically, we think Biocon should invest, but not aggressively. Thank you.